Everybody ready to start? So we have one last class, and you have one assignment, and then everybody can go for spring break. And you have that for the next week.
I'm gonna miss you though.
I know, I'll miss everyone too. I'll have the next assignment. I'll have it on Blackboard within sometime the next day or two. So you don't have to work on it over spring break, but if you want to, you can. It'll be out there. But
you're smiling like if you want us to do it.
No, you don't have to. I'm not going to grade it over spring break.
Oh, come on.
It's not due until like a week after,
What if I send it
or a
to
week
you,
and a half
like
after.
email?
You'll have plenty of time to do it. So if you want to start early, you can.
Give me your address. I'll drop it in your mailbox.
But today, today we want to look over the last stuff. There's been a lot of questions still about the stock quotes and the option quotes, so we'll review some of that stuff again today. We'll look at it again maybe for another security, so we'll look at that stuff again. But I also want to go over some of the foreign currency and foreign exchange stuff. I want to look at the quotes in the Wall Street Journal. There's not that much on this part now, but there will be on the next assignment, and there will be on the final exam maybe some stuff about how they're quoted in the paper, so we'll look at that also. And then, but first of all, to clarify the one thing that was confusing, the first two problems on there was a lot of questions. There's two things about it that just made it hard to specify exactly what I wanted. First of all, whenever you compute returns, you got to use the price from the previous period, so you always have one fewer return observations than you have price. So if you have 37 prices, you'll have 36 returns. So you always need one more price, or you need the price to go back one period before whenever you need to start computing returns. Another confusing thing is depending on the day of the month that you download historical data from Yahoo, it may or may not give you the last month. And so the day when I first computed that and put it down on the quiz, it did it one way, but then later it did it another way. Another thing is Yahoo gives you end of month prices and returns, but when you download it to Excel, it lists it as the first of the month, so it can be confusing when the time periods are. For the first ones, if it's easier, you can start at, I think, December 2012 and go to December 2015. Just as long as you get exactly 36 returns, so you have an even 3 years, that's what I want. If you start it one period sooner or later than otherwise, I won't count off for it. But you should have 36 return observations when you do that. So you have an even 3 years of returns, which means you want 37 price observations to compute those 36 returns.
I think I tried. If you do from 1st of December 2012
Yeah.
to 30th November 2015, it will give you exactly 36.
Okay, and it gives you the right number? Okay, yeah, if you're plus or minus as far as where you start and end, I'll be fine as long as you got 36 months of returns. I'll be okay with that. Another thing, there was a typo that I changed. For the standard deviation, I wanted the monthly standard deviation, not weekly. Monthly is what we did last time, and monthly, since you're getting monthly returns, it'll be a lot easier to get monthly standard deviations. Weekly would be a lot harder to compute since we got monthly returns there. So everything with that should be okay then. Any other questions about that first part? In that case, what I want to look at today, I want to look at the foreign exchange parts of what we have down. And then we can look at some stuff with we'll look at one of the foreign exchange securities, and then we'll also look at the options, how it's quoted for the foreign exchange stuff, as well as some of these other quotes that we've talked about. So far, and my smartboard works again, so I can type with this. I can write with it. So we've looked at stocks, and the way a lot of these markets work here, again, we have derivatives markets, and we have the underlying markets. So the underlying securities that we've looked at so far, we've looked at stocks. And then, based on stocks, the derivatives that you can have really are options. So you can have underlying stocks, and then you can have options basically on those underlying stocks. And so we looked at Apple stock and then Apple options. So two different securities that are kind of based on the same underlying company, with stock being the underlying security for the option. Another example of an underlying security that we can have is you can also have currency being an underlying security. And then on currency, you can have options, and you can also have futures. And as far as the other derivatives, again, there's also forwards and swaps, but those are more like contracts. You don't see them actively traded in organized markets. Right here, I'm just talking about the ones that are traded in organized markets. You don't usually see futures contracts on individual stocks. They can exist, but they're pretty rare. Usually, when you have futures on the stock market, they're actually going to be on something else that we'll come back to in a second. In addition to currency, you also have lots of commodities. And on commodities, you can also have options and futures. So you can have both of those derivatives. And then you can have futures on options and options on futures and options on futures on options and any kind of complicated mess with derivatives on derivatives on derivatives. You can have all sorts of stuff like that. You can have options on swaps and swaps of options. An option on a swap contract is called a swaption. That's the real word. It's not a joke. It's really called a swaption. And but an option on a future is not called an option or fusion or something. They don't have a word like that. But you can have all sorts of weird combinations of those things. And you can have combinations of different options, which we won't get into too much here. If you have a put and a call option together on one security, it's usually called a collar. And if you have it the other way around, call it a put, so it's reversed, it's called a straddle. And it's basically blocking in if the option goes up or down too much, then you'll profit on one of those. And if it stays within a certain range, then you'll profit on the other. We don't need to get into all those, but if you see any of those terms, you see like weird little terms running around the options markets. A lot of these are just referring to these combinations of different options and futures kind of stuck together to make like weird new little derivatives out of them. So you have all of those. So currency and commodities, they work very similarly. You have very similar options and futures on both currency and commodities, so we'll look at those a little bit today. In the financial markets, you don't actually have a whole lot of trading of the underlying commodities. Almost all the trading in terms of commodities that we talk about in financial markets, it's almost always on the derivatives, the options and the futures. The actual underlying stuff is not traded in financial markets all that much. And for some extent, the same is true with currency. The vast majority of currency trading in the markets is with the options and futures on the currency. It's not the actual underlying currency most of the time. And now, in addition to those, so you got the stocks, the currency, and the commodities. Then the other thing is we have not really another way that we kind of have this is you can have stocks, bonds, basically any of these underlying securities, including bonds also. Now, usually again, because bonds are so big, the underlying units, you don't see a lot of options on individual bonds or futures on individual bonds. But what you'll see is basically from all of these different securities, you'll have indices. So an index is basically just, it's not an actual security, it's just a made up number, usually computed by some formula, which basically gives you the value or the average value of a whole bunch of other underlying securities. So this is a an index is for one. Indices would be the plural, although we also say indexes a lot. It's not an actual security itself. It's just a measurement. It's like the average value of a whole bunch of underlying securities. But then once you have an index, there's a lot of other securities then based on those indexes. You can either have funds, and a fund is then it's basically a security that represents all those underlying securities that go into the index. And then you can have all these other derivatives. And these derivatives could be options, futures, and especially then swaps. Swaps are usually written on a lot of these indexes, although they can also be on regular firms. So there's a lot of sort of mixing and matching of a lot of these things and different combinations. And then, of course, you can also have options, futures, swaps on the funds that come from those indexes. So you can have a lot of different stuff mixed around. But all of it at the beginning, you got the underlying securities It's someplace at the beginning. And those underlying securities, that's the stocks, bonds, currency, commodities. Those are the real underlying securities. And then you can have either derivatives on the underlying securities, or you can have portfolios of those underlying securities, basically a whole bunch of them stuck together in some kind of fund, or stuck together in a fund or an index. And then you can have all sorts of derivatives on those funds and indexes. And then you can have indexes of derivatives and derivatives on indexes of derivatives and any kind of messed up combination of all that stuff. And it can get easy to get lost with some of them. So you got to keep track of which ones you're looking at, whether it's an underlying security or one of these kind of other derivatives that's based off that underlying security. Now funds and indexes, those we don't usually refer to those as being derivatives, although in a way they are derived from underlying securities. But I think the distinction is, normally when we talk about a derivative, it's based on one single underlying security. When we talk about a fund or an index, it's based on a whole bunch of underlying securities. And then you might have a derivative based on that fund, with the fund being the underlying security for another derivative. But it'd only be one fund. Make sense? It makes sense. And when people misunderstand that, then you have the whole financial system blow up in big crises like we had in 2006 to 2008, because people just get lost with it all and they don't really know what's going on with all that. So we got a lot of these different combinations and stuff like that here. And the thing is, some underlying securities, especially when you get into stuff like commodities, a lot of the trading is going to be either with the indexes or the derivatives, and there's actually very little trading of the actual underlying securities. And with commodities, that makes sense, because commodities refer to actual physical things, usually agricultural commodities, like some kind of stuff from the farm, wheat or pork bellies and orange juice, stuff like that. And usually you don't want to be actually moving around the physical quantities because you need a big warehouse and you need trucks and all this other stuff. So it's a lot easier just to trade the financial securities, the derivatives based off that, because then you still can get exposure to it, but you don't actually have to take the underlying physical commodities because they're big and bulky and they rot and all these other things like that. With the financial securities, stocks, bonds, and currency, it's a little bit easier because the underlying securities are themselves financial securities, so you don't really need like trucks to move them around and stuff like that, and big warehouses or farms to keep them at. So it's a little bit easier to trade underlying securities, but even with those, some of those still, a lot of the trading is actually done with either the indexes or the derivatives, or derivatives of the index and indexes of derivatives, stuff like that. So that's what we want to look at. Easiest way to start looking at this, maybe, let's just look at Yahoo Finance, actually how they list all these things. Because if you look at what's quoted on a website like Yahoo Finance, it gives an indication of what's considered to be important in the market. And you can get an idea of how these things are actually traded then, as far as what types of securities we see traded there. So we go to a website again like Yahoo Finance. The most useful part for us probably is this, where they have market data, and it has it split into these main different types of categories we've been talking about here. So if we look at what they have here, first thing they list here, market performance, the very first line, they give you three big numbers. Those are all referring to the stock market, but all three of those numbers are not referring to individual stocks, they're referring to stock indexes or indices. So you get the S&P 500 index, which again we mentioned before. That is the average price of the 500 largest stocks traded on the New York Stock Exchange and NASDAQ. So take the 500 largest stocks, take all their prices, take an average, and it's a weighted average, weighted by market capitalization. So the bigger the stock, the more it counts in the index. And if you take then the average of all those prices together, that's what gives you that index value. So that index, you can't actually go and buy that index on its own directly. Another way you could directly buy the index on its own is to go buy all 500 stocks and to buy them weighted according to how big their market caps are. And that market cap, it changes every day. So it actually would be really difficult to go and buy all 500 like that. But if you want to know how the overall market does, that's one of the broadest measures and one of the main measures that's used. Now in addition to that, we got the Dow Jones Industrial Average, or just referred to as the Dow. That is 30 large stocks traded originally just on the New York Stock Exchange. Now it includes some NASDAQ stocks. It is complicated in a very messed up way because the Dow was reported because it's the oldest and most historical of the different stock indexes. It was the first real stock index to be invented back in the 1890s by Charles Dow. And the way he did it is he he basically had a bunch of methods for measuring industrial activity. Basically went and sat around outside Philadelphia and New York and tried to count how much smoke was coming out of different smokestacks, and he used that then to predict market movements, and he made a fortune off of it. Because before that they didn't have real information reported, and then he helped use that information to start the Wall Street Journal and all this other stuff that started the whole financial media industry. But anyway, the way he computed a stock index back then is he just took the 30 stocks that he could get information on back in the 1890s, which was mostly like railroad companies, because that's what was driving the stock market and the economy back then. And he just took an average of the 30, but he weighted the average according to the price. And the price of different shares of stocks really depends on how many shares are outstanding. So you can have a lot of shares outstanding and a small price, but it might be a really large company because you got lots of shares. Or you can have very few shares outstanding and a very large stock price, but you might still be a pretty small company because you don't have that many shares outstanding. So the price of an individual share of stock from one stock to the other, it's really pretty much random. It just depends on how many shares outstanding there are. It doesn't really give you any indication of how valuable the stock is or how big the firm is. But the thing is, back then there were no computers or calculators, so for him that was the easiest way to compute it, just to weight it by price. And so he did that way because it's easy, and that persisted until now. So it's like a really weird, messed up method to compute the price of the Dow Jones, which makes it really sometimes inaccurate and all messed up the way the price moves on it, which is why professionals don't ever want to use it, and it's really not that useful professionally. But because it's the oldest and it's most widely reported in the media, that's usually what's reported first. So you see the Dow reported all the time, even though its construction is really messed up mathematically. And then the other index you get here is the NASDAQ Composite, which is basically all the firms that trade on NASDAQ. And so if you compare the S&P 500 and the NASDAQ Composite, S&P 500 is basically the 500 largest firms, so it's giving you the firms that are large and liquid. Since NASDAQ is mostly small firms, it's more an index of all the small firms, which tend to be technology type firms. So it gives you a measure of how, a broader measure with lots of small firms, how that's doing. So those are the three indexes you get, and as you can see from the little chart there, they're really highly correlated. So I mean, even though the Dow Jones is a bit messed up the way it's computed, they're highly correlated. And the problem with the Dow is you get 2 or 3 companies that are in there that are not necessarily that important, but they just have large dollar values of their stock price, and so they kind of dominate the index, even though they aren't all that important in the economy. And then they kind of randomly determine the Dow to a large extent. And it's just not that useful to do it that way. And so you got those 3 indexes. So those 3 indexes, you cannot actually buy those 3 indexes, but what you could buy is you could buy either funds that track those indexes, or you could buy derivatives that track those indexes. So if you wanted to get exposure to the index, even though the index itself you can't buy, you could buy a fund that tracks it, or you could buy a derivative on it. And if we look at either of them, we can probably get some of the information on it. So if we take the S&P 500, you see the information you get on the quote, you don't get all the stuff like volume, bid-ask spread, and all that stuff, because it's not actually trading as a security, it's just an index. So all you get is the prices. You get the previous closing price, the opening price, the range, you can get the chart, and you can get historical prices for it, but you can't get the other information because it doesn't really exist. And again, some of the stuff from a quote. This price there, that's the last price that was transacted, so that's the last price. This is the price change over the day, and this is the return over the day. And that's given for any kind of quote, so you have those things. Now, if you wanted to buy the S&P 500, some of the ways that, again, you could actually trade it is we go to mutual funds, and we'll come back to mutual funds after spring break, so we won't spend too much time on them now. But there's lots of mutual funds that track the S&P 500 index. So you could buy an S&P 500 index fund. That'd be one way to get exposure to the S&P 500 index, is you buy an index fund. And some of the biggest funds out there are S&P 500 index funds. They aren't coming up on this one right now. But if you did some more searching, you'd find them easy enough. The other way to get exposure to it, and mutual funds, open-ended mutual funds, they don't trade on the stock exchange, so we're not looking at them right now. But we do have, we go down here, we have ETFs. ETFs are exchange-traded funds, so as the name implies, they trade on the stock exchange. And some of the biggest ETFs actually track the S&P 500 index. So there's one called SPY that we can look at as a ticker. This is an exchange-traded fund. So it is a security, and it acts like a holding company. And all this company owns is the 500 stocks that make up the S&P 500 index. So if you actually wanted to buy the index, you can't buy the index directly, but you could buy this exchange-traded fund, which is going to be the closest thing you could get probably to the index. So it's an exchange-traded fund, and it just holds those 500 stocks that make up the index. And if we compare it to the index, see its price is $199.24, and then the S&P 500 index is 1987. So the ETF is roughly 1/10 the value of the index. They haven't done so; it's roughly 1/10 the value. And you can see this then trades in real time. So if you look at the quote for an ETF here, you've got all the information like you would for a stock, because it's an actual security that trades on the exchange just like a stock. So you got the last price here. So that's the last price, and then where it says previous close, that would be the last closing price, would be the 199.38. But this is the last price right now, and it's trading all the time because the market's open right now. And then you got this is the daily return you have right now. So you got all that information for this, and for this one, we could look at the order book. You could buy options on this ETF. So there's lots of options here. So if you wanted options on the S&P 500 index, you could buy options on this ETF, on this exchange-traded fund, and that would be equivalent to getting options on the S&P 500 index. And usually, this exchange-traded fund and options on it are often the most actively traded securities out there on the stock exchange. So usually, it's not an actual individual stock that's the most popular security to trade on the stock exchange. It'll be some of these ETFs, especially this one is often the most highly traded security out there on the exchange. And you can see from its volume there, remember the volume for Apple was like 50 million shares, and Apple's a really big actively traded company. If you look at the average volume for this one, it's 3 times as much as it was for Apple. So this is a really actively traded security. And these are relatively new. These ETFs, they've been around for about 20 years, but they've only been popular maybe the last 10 years. So it's a relatively new kind of security, but you can see it, they really dominate a lot of the trading out there in the markets now. So most trading in the stock exchange is actually not stocks, it's like these ETFs and securities related to these. And so it's really actively traded there now. Questions about it? Some stuff using the chart. If we wanted to see like a 1-year return, one thing you could do is you could just take the chart for 1 year. So if I click on a 1-year chart of it, again, you get information here. So I just got this chart over a 1-year period. Just using the chart, it just gives you it's kind of depending what you're doing, it might be easier just to look at a chart rather than downloading the historical prices. If you go to the very end, you get what the price is right now. So as of today, as close as I can get it, 199.31. If I go back to the beginning here, it gives me the information, and it's not all fitting on the screen. 199.26 is what it was as of the last closing price. And if I go back here to the very beginning, it'll give me the price as of 1 year ago, so March 12, 2015, which was 207.10. It's in the little, so you get the little black indicator there. It gives what the price was a year ago. The blue is the price right now, and then this was the volume in the red indicator down there. Or no, that was that's the volume. So you can get this if you really need to estimate the price over 1 year. And then if you wanted a 1-year return, so if the price 1 year ago was 207 and the price now is 199, the difference between those, that's the dollar return over 1 year. And if you take it as a percent of the price a year ago, you get the percentage return. So if I take 199.24 minus 207.10 divided by 207.10, that'd be a 1-year return. And that's going to be negative because 199 is lower than 207, so it's gone down. It's gone down by what, about 7 points out of 200. So it's like a minus 3.5% or something like that. And if you actually go right here and just put your cursor on it, in that little box up there, it gives you what the return was over the previous year. So this is a 1-year return. It's got it there minus 3.74%, and it's updating it in real time there. So that's what the return has been over the past 1 year period. So you can use these charts to check some of these calculations. And if you go into if you actually download the historical prices there, then you should be able to get the same thing by actually looking at what the price was a year ago and computing the difference from now. So these are some of the tools you can use if you actually need to work or compute with stock returns at all.
You said it was 199 minus the 2.
Yes, you want to take the price now, which is 199, keeps changing, 199.30, minus the price from 1 year ago. And the price 1 year ago, according to the chart here, is, if I can get it to go back there, right, was, now I got it off. It was 207.10, the price 1 year ago.
And then divided by.
Then divided by the starting price, which was the 199, no, which is the 207.10, is the starting price. So anytime you compute a return against your most recent value minus your previous value divided by the previous value. And here it's 1 year, so we want the previous value to be the price 1 year ago. Any questions about that? Okay, so we've got that information there. If we go back to the stuff on Yahoo Finance, see what other information they think is important to show. So if we look at, again, the kind of information they quote here, so you got this these main stock indexes, and those are the 3 main stock indexes for the U.S. The little chart went away, the pretty little graph. You've then got just the stocks that have been moving a lot so far today. So you got market movers. Most actives are the stocks that have the highest volume today. And if you look at some of the most active stocks, you see what they got here? They got UWTI. This is also an exchange-traded fund. It's not an actual stock. And it's got 126 million shares. So that one we just looked at, SPY, is even more. It was 150 million shares. So it's not even listed on there. It's even more. Bank of America is the second most active today. So that's the most active actual stock. The third one is iPath, S&P 500. That is also an exchange-traded fund. The fourth one, Direction Daily Gold, that's an exchange-traded fund that rather than holding a stock, it holds gold. So it's a fund, again, if you want exposure to gold, rather than buying actually physical, big, heavy pieces of metal that you need trucks and security guards and all that stuff for, you can just buy an exchange-traded fund, and that fund owns gold then. So you can get exposure to gold that way. And then the fifth one is a mining company, which is an actual real share of stock. So out of the 5 most popular, 3 of them there are exchange-traded funds rather than actual stocks. Only 2 of the 5 most actively traded are actual stocks. So again, the most trading on the stock market these days, it's actually done by these funds, not by the actual underlying stocks. Questions about any of those? And as far as what these funds track, again, this first one, Velocity shares 3 times crude oil. This is an exchange-traded fund that tracks a commodity. So if you want to invest in oil, again, you don't want to buy giant tanks full of oil. You want to invest in security that tracks oil. So this is an exchange-traded note, actually. It's actually, don't worry about the difference. Exchange-traded notes, exchange-traded funds, very similar. They just work differently. We won't get into the difference right now. Not only does it track the price of oil, it actually gives you 3 times the price of oil. So a lot of these funds can be levered, they can be inverse, they can have all sorts of other kind of tweaks on their formula. So what that means is if the price of oil goes up by 10%, the price of this fund goes up by 30%. So it goes up 3 times the price of oil. So it can really, again, magnify your earnings or magnify your losses very much. And that's what this, and that is the most popular traded one today. So again, if you think oil is moving around in the market a lot, traders now, they don't go and buy oil. They buy exchange-traded notes linked to oil. And if you think oil is going up, then rather than just get the same increase in the price of oil going up, you can get 3 times that by buying one of these levered funds like this. That's why they're so popular now in the markets. And these exchange-traded notes, ETNs, they're probably the next thing to explode and destroy the financial system, sometimes in the next couple of years, but it hasn't happened yet. These notes are they've only been around for a couple of years. They're even newer than the exchange-traded funds, and there's a technical difference in that an exchange-traded fund is, again, a holding company that owns all those underlying securities or would actually own the underlying oil that's listed here. An exchange-traded note is similar, but it doesn't actually own anything underlying. It just promises to pay whatever the value of that underlying security is, and it doesn't even bother to own it. So it's essentially an unsecured exchange-traded fund, where an exchange-traded fund is at least secured because it owns the underlying commodity or the underlying security, whatever it might be. These ETNs are just totally unsecured, but other than that, they're the same. So we'll see what happens with those over the next decade, but they're likely to be trouble eventually. Where were we then? The other ones traded there, just an example again, Bank of America, a real company. We'll look at that when we get to the banking chapter. The IPATH S&P 500 VIX, this is another interesting thing, and it is often the most widely traded security out there in the financial market, so it's useful knowing just what it is actually. It is, again, an ETN, so it's an exchange-traded note, so it's actually an unsecured fund that actually has no underlying holdings. And what it tracks is not the S&P 500 index, but it tracks futures on the S&P 500 index, but it doesn't actually just track the futures price. So it's already an unsecured fund that's tracking a derivative on an index, but it actually tracks not the S&P 500 index, but a derivative index of the S&P 500 called the VIX. And what the VIX measures is, it measures the expected hypothetical volatility of the S&P 500 index. So if you remember, when we just, on the first two problems there, we computed the standard deviation of daily returns for a stock. So what the VIX is, it's a measure of the expected standard deviation of daily returns for the S&P 500 index. So that's itself already a complicated formula. And then you can issue futures contracts on that expected value of the S&P 500 index's daily standard deviation of returns. And this is then an unsecured fund tracking that standard deviation of the daily value of the S&P 500 index futures. So they get really complicated really quickly, and this is actually the most popular security out there a lot. So basically, this index VIX, since it measures uncertainty about the S&P 500, which is what the standard deviation of returns measures, it's usually called the fear index or the uncertainty index. So it basically measures how fearful or uncertain investors are about the stock market. And so if you think the markets are really uncertain, or the uncertainty is going to increase, or people should be really afraid, you can actually invest in that through this kind of security here. So when you have a lot of economic uncertainty, investors really like to buy this security because it goes up when people are more uncertain and more afraid about the market. And so it's an indicator, and right now, today at least, it is the third most actively traded security out there. So a lot of people are actually betting on uncertainty in the market through this. And that's a lot of trading. I mean, 94 million shares, it's about twice as popular as a firm like Apple to trade their stock. So if you think Apple's a large and popular security, this security measuring uncertainty is twice as popular here. So it's a big thing to invest in those. And very few investors even now understand those because they're really new and it's really complicated, as you can tell with that. And so that's what you have there. Any questions about that? Yes?
Can you go back to these ETFs? Like, you just talked about it like no big deal, but the fact that it's gonna
explode and destroy the whole world and the financial system? Well, if you think the financial system is going to explode, this fear index, ETN, would be a good thing to invest in, unless it itself is what explodes and destroys everything.
Okay.
And then you could invest in something else, I guess. Well, then it doesn't matter, because probably whatever you invest in is not going to pay off. That's when you need the actual physical truckloads of gold rather than some fancy security based on it. But that's hard to buy now, because you need a warehouse and security guards. So these are some of the, again, most popular securities out there. So they're really actively traded and they're really important in the markets. The fourth one, I guess, answering that, if you think the markets are really uncertain and you can't trust the markets, fourth most popular security here is you can invest in gold, just old-fashioned gold. But again, this is also an exchange-traded fund based on gold, so it's not actually the good, heavy pieces of metal. And this is actually giving us an opposite thing. This is a bear 3x ETF. What that means is when the price of gold goes up, this ETF goes down. And it goes down by 3 times the price of gold. So if gold goes up by 10%, this exchange-traded fund is going to go down by 30%. So you got these a lot of leverage going around the system with these kind of funds and securities like this. So it's really easy, again, to magnify losses and magnify gains. And the weird thing you can do is if you think this that the price of gold is going to go up, then you could, and this is a bear 3 times the price of gold, you could short sell this, which means you would still make profits when gold goes up because you're short selling an inverse ETF, or you could buy put options on it, or you could short sell call options on this one, and that would actually give you the way to make about 30 times as much as however the price of gold goes, unless you get the wrong way and then go down the wrong way. But there's a lot of crazy leverage and large movements in the system based on these. As far as if it's going to destroy the whole system, I know we have to wait and see with that. So those are what you see with the most active securities out there. And usually if you look at the big gainers and the big losers, it's always going to be these ETNs because they give you 3 times whatever the underlying security is. So if the underlying security went up a lot, the ETN is always going to go by 3 times as much. So they're usually going to be the big gainers and big losers any day. So if you look any particular day, actually I'll get some little weird little stocks there that are big gainers and losers. But for large firms, it's going to, see these have almost no trading, so they're really insignificant. You'll see these ETFs up there. Other questions about that right now? We're going to look at funds all next week after spring break, so we'll come back to a lot of these funds when we get to the fund chapter. So we'll see these again soon. The next section you got here is currencies. So again, currencies, you have 2 main ways to trade currencies. You got the spot market, which is just trading the currency, the actual real currency in real time today. And then you got all the derivatives markets on it. And most of the action is in the derivatives markets. The prices you're given, though, is usually the spot price. So these are spot prices. And for any currency, you can quote it. You can quote the price of, for example, the first one here, euros and dollars. You can say how many dollars it takes to buy 1 euro, or how many euros it takes to buy $1. And just one be the inverse of the other. And you just have to, one thing, be careful which one you're looking at, whether it's the what we call the direct quote or the indirect quote. And usually it's just formatted so that the numbers are not real small or real big. Like with the Japanese yen, you almost always get how many yen you get for $1, because if you did it the other way, the value would be like 0.00 something and be a real small number, and it's just messy to deal with then. So usually you have it, the larger currency in units of the smaller currency. Other way around. Smaller currency in units of the larger currency, but it depends on their relative price difference, really. So if we look at one of these, the information you get for it, if we take the euro-dollar exchange rate, again, it's a security, so you get bid and ask prices, but you don't get all the other underlying information because it's a security. You don't really have stuff like volume given here, and you don't have most of the other things. There's no dividends, there's no earnings, or stuff like that, because it's just currency. So you don't have all these other statistics. You just have the prices, really, is what you have. So again, this is a currency exchange rate, and then you can have lots of different derivatives or funds based on the currency. So you can have exchange-traded funds denominated in US dollars, but all those funds hold might be euros. So if you want to buy euros, but you don't actually want to buy the actual euro banknotes, you could buy, again, a fund that holds euros, and you could get exposure that way. And you could buy all those kind of leveraged ones. You could get 2 times the euro rate, 3 times. You get inverse 3 times what the euro-US dollar exchange rate is. And so that's the way a lot of these currencies are traded in markets now, too, through those same kind of funds. And then you also have all the options and futures on the currencies. So you can see a lot of that information here. As far as getting the return, so this is the quote right now, $1. 1 euro would give you 1.11 US dollars. Because the euro is worth more than the dollar, so $1 would give you something less than a euro. So one euro gives $1.11. And the change over today has been 1.66%. Has been the change there. So when that return is higher, that means that the euro has gotten more valuable and the US dollar has gotten less valuable, the way this quote is given to us right now. And if we want to see it over time, again, you can take the chart. If I click on the 1-year chart, I can see the rate right now is, again, 111, and the rate 1 year ago was 105. That means 1 year ago, 1 euro only bought $1.05 US, or you could say it took $1.05 US to buy 1 euro, and now it takes 111 US dollars to buy 1 euro. So the euro's gotten stronger and the US dollar has gotten weaker there. It takes more US dollars now to buy 1 euro. Although the US dollar is a lot stronger than it was, say, 3 or 4 years ago. And from that there, over this 1 year period, we can see that the percentage change here is about 6%. So the euro's gotten about 6% stronger relative to the dollar, according to this chart here, 5.99%. Questions about that?
Can you show one more time where you would find the dollar returns?
If I want it for the day, I could just take this return right here. If I want it for the year here, then I've got, we've got the euro, if I just get the cursor to stay on there, it might just stay still. It gives it there as being 5.99%, because I have a 1 year chart here. Or if I look at what the price was a year ago, if I take again this 111 and 105, if I take the 111 minus 105 divided by 105, that would give me that 6%. It would give me that return there. And now if I wanted that return the other way around, so that was the US dollar euro return. And we can get any of the other ones there too. If we go to the currency center as far as what they list for currencies, again, you have most of the different major currencies listed here. The majors are, like the name implies, the main world currencies. You usually get euros, dollars, Australian dollars, British pounds, Japanese yen, Canadian dollars, and Swiss francs. European crosses are all the major European currencies. Yen is Japanese currency with most other major currencies in the world. Asia Pacific gives you again other major Asian currencies. Emerging markets is the other random ones that don't fit into European or Asian. Scandi is the Scandinavian currencies, and then you have their little tool there to convert everything. If you look at what they list down here, they give you ETFs based on currencies. So again, these are ETFs based on currencies. If we take, not that one, but the second one, we can look at an example of, again, what these would look like. This is a ProShares Ultra Euro. So this is, again, an exchange-traded fund. It's based on the US dollar-euro exchange rate. And what it gives you basically whatever the percentage change is for the US dollar-euro rate, it gives you twice that. So it's a 2 times levered fund. So as we just saw a minute ago, that US dollar-euro exchange rate for the day was like 1.6%. So this one's giving you roughly twice that, 3.4%, as its daily return. So its return will be twice whatever the euro-US dollar exchange rate return is. And so this, again, is an actual fund. You got all the fund information here. Volume, all the other return information, how many shares there are, stuff like that. Questions about that?
Yes, sir. On that, where does it say anywhere that it pays out 2 times, or you just know that because you saw the 3 times?
I know that because
I'm just saying how.
if you want to, yeah, it's not, usually it's given in the name. This one is not given in the name, which isn't all that helpful. I just know the ProShare Ultra series of exchange traded funds are all like 2 times. If you went into the profile here, for any of those funds, if you read the profile, it gives you a little paragraph that says basically what it's going to pay. And actually what's useful there is it's going to say what the underlying security is that it pays on. Because a lot of times from the name, you don't know the underlying security. So here it's useful to know that, well, this one from the name, it says euro. So that could mean euro stocks, euro bonds, euro currency. It could mean a lot of things. So it actually says here that it's going to invest in, and it's not the way it gets 2 times the return is it basically invests in derivatives. So it invests in swaps, futures, and forwards in order to get that 2 times the return. So it buys those derivatives to get that. And then it doesn't even say it in there, does it? No, it never says 2 times euro in there. Really not helpful then. If you actually Googled it and went to underlying fund website, you could find that out, but that seems to be a lot of trouble to go through. Probably most people who buy it don't even know what it tracks anyway. So if you actually go to the ProShares website, hopefully, yeah, then it'll actually say it. 2 times the daily performance of the US dollar price of the euro. So with a lot of trouble, you can actually find out what you're investing in. But it's not immediately clear, just from looking at a quote or even what's on Yahoo Finance, which is interesting to know. So there you can actually get some more information about it.
Is the forward exchange rate also listed with the other?
The forward exchange rate?
Yeah.
It is not listed. That is a good question. And this is where it gets into the difference on what they actually give on Yahoo Finance and other free websites and what they don't give. Here, Yahoo doesn't really give very much forward or future prices. It doesn't give that much, mostly because those are sold by the exchange, and so Yahoo won't give it away for free. If you had a subscription-based site for quotes, then you could probably get some of that information. The cheapest place to get those actual forward and future prices on a daily basis would be to actually go to the physical paper. So that's one reason we have these, because they don't give this for free on the internet. And the newspaper's not free, but I bought these all for you because they are my old papers over the last year, so I saved them for you. And you can get the actual, the forwards and futures prices here. So this is where you can get it. Not that I'm advertising the Wall Street Journal or anything. But that's where you have to go to get that. You don't get it, you could probably find it on the internet for free, but not in one easy website like you have on Yahoo Finance.
It's not even like on the Wall Street Journal if you have a subscription.
If you have a subscription, it's probably on there. I think if you go to the Wall Street Journal under their market section, they have a bunch of their underlying data, and it should be in there. You should be able to find it, because they have everything that's in the paper version on the web version. So you should be able to get it there. And again, the forward price, basically what it's going to give you is not the US dollar euro exchange rate today, but what it's expected to be 30 days in the future, 90 days in the future, and at other points in the future. That's what you're going to get on the forward if you get quotes for the forwards. And those will also change every day then. The other stuff that we are given here, as far as information about futures and forwards that you're given on a website like this, you have the commodities here. And the commodities prices, these are basically all futures contracts. So you get futures on commodities, but you don't get them for all of the financial items. Like, and really the most popular futures are not futures on commodities, but it's futures on financial things. So you can buy futures contracts on all these financial indexes, like the S&P 500, or things like the term spread or a U.S. bond yield curve. You can get futures on all those, and those are usually the most popular traded futures contracts. But the ones that are listed here tend to be these commodities futures. So if we look at what we're given there, for commodities here, you see you've got it on energy, metal, grains, livestock, soft goods, and these are all futures contracts then. So you get a bunch of futures contracts. So what they have is they have an expiration date, April 16th. So these are basically what the expected price is going to be, not today, but on April 16th, so roughly a month ahead. And you got it for those. And for each of those, you get these futures chains, which, like an option, you have it for a bunch of different amounts and a bunch of different dates. So you can get here Brent crude oil. So if you, again, want to invest in oil, one option is that 3 times levered ETN. It's the most popular traded security out there on the stock market today. Or you could go to the futures markets. But on the futures markets, you've got all these different future dates that you might need to consider as far as when you want to invest in it. And you can see the oil price here right now is expected to go up. That right now, the one, whatever time this is going to be, the 16th, it's got a price of 40. And going further out in the future, the price goes up to 50. So it seems right now the futures market expects the price here to go up. So if you expect the price to go up, you can either make a little bit of money here in the futures market, or you could buy that 3 times ETN and basically get 3 times the profit sooner, which is why it's the most popular traded security out there today. And one place you can get some of this, if you go to indices, that's where you can get some of the financial ones. So these are still commodity indexes, although you can get stuff like, you got the Dow Jones Commodity Industrial. So Dow Jones Industrial Average, the second one here, this is a futures contract on the Dow Jones Stock Index. So you can invest in the stock index either through an ETN or in a futures contract here. You've got gold, silver ETN, gold, silver futures contracts. You've got the 10-year Treasury note, so you can buy futures contracts on Treasury bonds. So that's a futures contract on an individual bond as the underlying security, rather than an index or one of these other stocks. You've got the Bitcoin index, which is really trendy now, and you can actually get futures contracts on it. And then some of these other ones, I don't even know what that one stands for. So that's the kind of stuff you got as far as futures quotes here. And again, futures quotes, they're going to be somewhat like options quotes. If we look at one, you don't get all this underlying information, you basically just have the price there. You have the price, and sometimes it'll give you open interest as far as how many contracts are outstanding, kind of like shares outstanding. So that's not the price of the index, but the price of the futures contract. Okay, and other stuff, if we go back again, you've got mutual funds, which we'll come back to after spring break. You got ETFs, which we'll also come back to after spring break, but we've looked at a little bit now. And so these are funds that are traded on the stock market. And then you have the options, which we looked at last time. So questions about those so far? And what I want to look at next then is what this would look like if you actually needed to find some of this stuff in the paper. So some of these we can get in the paper. And really a lot of the stuff that's given in the paper for us so this is today's here, where we got a bunch of stuff about, okay, so if you look at any of the, if you look at the paper on any given day, and even in the Wall Street Journal, the first thing they tend to give, pretty much the same as the first thing that Yahoo gives. So on Yahoo, the first three things that we got were the three main stock market indexes. So pretty much the same thing in the Wall Street Journal. If you look at the beginning of their whole little financial data section, pretty much the same three indexes and even the same format. You got the values and then you got the little chart. Although here they give a fancier little chart for each of them. So you got, again, the Dow Jones, you got the S&P 500, and then the NASDAQ composite. So these three main U.S. indexes are the first three that you're given there. And then below it, you've got all the other indexes that you could want. How does my thing focus on? Okay, it's a bit blurry, but if you have your own papers, you can check it later. But basically what you got is you have a whole bunch of other indexes. In addition to the S&P 500, so if you can't read it all, you got the S&P 500 index, you got the mid-cap 400, which is the next 400 firms after the top 500, and then you've got a whole bunch of other sector indexes and small caps, so just different ways to slice up the stock market. That's what basically all these sections here is, just all different stock indexes. And then you've got a whole bunch of other indexes here, which are for things like different industries, biotech, gold, silver, other things that you have there, just other indexes. You've got then basically, as we looked on Yahoo, you got the most active stocks and stocks that are traded early and late. So these are just stocks that have had a lot of activity over the last day. So those are the big movers and a lot of activity. And you can see even here, most active. First one is an ETF, second one is an ETF, third one I can't read because it's blurry on the screen. I don't know what it is. It's an actual stock. And the fourth one is an ETF. So 3 out of the 4, again, are these exchange-traded funds, with the first one being the, that's 3 times one of the sector indexes. The second one is that S&P 500 index ETF. And the fourth one is the gold ETF again. So these most actively traded ones tend to be these type of things. All the way on the side here, this is just the overall statistics for the entire market for the New York Stock Exchange. This, you got New York Stock Exchange and you got NASDAQ, and it's just the overall total volume for the market. So volume, all the stocks together, total number of stocks that went up, went down, how many total trades there were, how many highs, lows, just all this kind of general information about the whole market. The next stuff that you're given then this is just below it. You've got all the international indexes. So every major market has its own index, and then there's indexes for each region. So you've got all the international indexes, and looking at some of those are mentioned in the news article we have. So you just need to, for those ones, just either look at them on Yahoo Finance, and you can see what the index is and where it measures the stock performance of, or you can search for them anywhere on the internet to find out about them. They're all easy to find out about. So you got all the major worldwide indexes, you got their values and how they changed. Again, you've got a lot about the stocks, the most active stocks is basically all the rest of it here based on which ones went up and down the most in price and had the most volume. So you've got all that. All this stuff we looked at before with all the interest rates, this we looked at before. And then you've got your foreign currencies. So then you just got the list of spot prices for all your currencies. And you got them all listed here. Again, they do it, the direct quote, how many of the currency you get for $1 and how many dollars you get for their currency. I know it's blurry, but if you look in your paper, that's basically just what you're getting. So as long as you can see the headline here, this is what it is. And those are all spot rates. So those are the current values for all those currencies. And then you've also got the current values for just the major commodities there, just for oil and some of the major commodity indexes there. So that's where you can find, so far, that's not really anything new compared to what we had on Yahoo Finance. It's actually pretty much the same stuff. If you want the actual detailed stuff that you don't get on Yahoo Finance, if you go to the next page here, where it lists commodities, this is sort of the best place you can go if you want all the detailed futures information. So all this page here is futures prices. So these are all futures quotes. So if you actually want to see the actual prices of the futures contracts for basically all these commodities, that's what this whole section is here. It's all a little small font. It doesn't come through that good. But so the first ones, these are all metals, copper, gold, platinum, all that stuff. You got all the agricultural ones in the middle, wheat, cocoa, coffee, sugar, etc. And then at the end here, these are all the futures contracts on the currencies. So you got futures prices for all the different currencies there. And then you got interest rate futures on different U.S. Treasury bonds, and then index futures on stock market indexes. So you get all the different futures contracts on both the commodities, the metals, the currencies, and the financial indexes. So that's where you actually get this information. And that's not as easy to get on the internet then. So you don't actually get that for free on Yahoo Finance too easily. And here you have the actual spot prices of everything. So what the cash prices are right now for all those different currencies, or not currencies, but commodities. Questions about all that? So that's where you can actually find the actual futures information. And we don't have that on assignment now, so we'll probably see it again on the exam, something like that. Probably look at one of these quotes. And the quotes, it just gives you the prices, and then the open interest, and basically the change in prices. It's basically just the prices and how many contracts were traded. The other stuff you get, here's just economic information, which this is not an economics class, so we can pretend it doesn't exist for right now. Then we got, next page is all the bond information we looked at last time, so I don't need to put that up again. This is not going to look exciting, but then you got 2 or 3 pages of all just stock quotes. So these are then where you get the biggest 1,000 stocks, you got a whole bunch of stock quotes. How many stock quotes? 1,000. It says 1,000 at the very top. You got the 1,000 biggest stocks, and you just got their individual quotes. So you just got the stock name, ticker, price, and then that daily return, the change in the price. So you got a whole bunch of those. First for everything on the New York Stock Exchange, and then on NASDAQ. So you got all that stuff. We aren't going to look at those in detail because, again, it's too small. After all the stocks, then you got the same stuff pretty much for first of all, mutual funds, as it says up top, the main mutual funds, and those are open-end mutual funds, which, again, this is a little bit confusing, and it'll make more sense after we look at the mutual fund chapter after spring break. Those are open-end mutual funds at the top half. They're not traded on the stock exchange. So open-end mutual funds don't actually trade on the stock exchange, which is kind of a thing that most people don't understand. Even most investors don't really understand that. But then you also have here the exchange-traded portfolios. So these are all these new exchange-traded funds and exchange-traded notes that are traded on the stock exchange. And you basically just have their name, ticker, and then their price and the change in price. So you just have the basic information. If you can't read them, it's okay. That's just what it is, just the name and the price. So you're just getting the basic quote information there. And you got that for all of those. And then you got the ones with the new high price, new low price, and then dividends that are paid on different ones. And that is where you get actually most of this information. So what you could see that we had, certain stuff you get in the paper. So in the paper you can get futures quotes, which you can't get so easily on the internet for free. On both the internet or the paper, you can get all the stock information, so all the stock quotes are there. What did we see on the internet for quotes that we didn't see here in the Wall Street Journal, though?
You can look at that interactive graph.
Yeah, you got the graph. So in the paper here, you don't have all the graphs. That's right, the internet's going to give you a lot of those graphs. And as far as actual quotes, there were no options quotes here in the paper. So the paper doesn't really give you options quotes because there's just too many. You know, if you looked at Netflix or Apple, there's like 100 different options because you got all those different strike prices. If you wanted options quotes in here, it'd have to be like the phone book every day, like that thick of paper, and nobody wants to carry that around or deliver that or whatever. So you don't get all the options quotes here. You get the other stuff, but not the options. And the one other thing that we've mentioned but not looked at here is somewhere in here they got swaps, a little bit of swap information, but it is obscure and hidden someplace because I don't see it right now. So let's talk about swaps for a minute then. Because we haven't mentioned swaps too much lately. So we mentioned most of the stuff that we were looking at. So if I go back to this little chart first of all, now that we've looked at all the stuff, that information that's out there, hopefully this makes a little bit more sense now. So again, your underlying securities, you got stocks, bonds, currency, commodities. And again, as an investor or as anyone in the markets, if you wanted to invest in any of those, or if you're looking at issuing those, the way to go about doing it, it really depends on what kind of exposure you want. If you're trying to do something, you know, very safe and conservative, you might actually want to invest in the underlying security. If you're into speculation and some type of trading on information, then you might want to get as much leverage as you can possibly, which would be a very high-risk strategy. But as far as evaluating different investment options out there, there's a lot of ways to invest in things other than the underlying security, and a lot of those other ways can be very risky, but they can give you a lot higher returns. So other than those, you can invest either in an index of many of the underlying securities, and indexes can track, again, any of those underlying or any combination of them. So you got stock indexes, bond indexes, currency indexes, commodity indexes, and then you got index that combine all of them together, any combination of stocks and bonds, stocks and currency, although you don't usually see that too much, stocks and commodities. So there's a lot of funds, again, that might track, say gold. If you invest in a fund that invests in the gold sector, it might have stocks of gold mining companies and then actual underlying shares of gold, either probably futures or something on actual gold. So you can get any index that does combinations of those. And then from that, you can invest in either those funds or derivatives of the funds and funds of derivatives. So again, some of those ETFs, what they held was a bunch of futures contracts. So it's a fund that holds a bunch of derivatives. Or you could buy options on those exchange-traded funds. So you can buy derivatives on the funds. Or you could buy derivatives on the funds that hold derivatives. And again, any combination of that then. So there's a lot of different complicated ways to do that. And it starts giving you leverage where you can earn 2 or 3 times whatever the underlying security might be. And pretty soon they're supposed to start trading those funds that'll pay out 10 times the value of the underlying security. And they're just waiting for the SEC to approve that, to say that there's no way that could go wrong. And that'll probably be trading within the next year. By the end of the year, we'll have a bunch of those that pay 10 times the value, or you could lose 10 times the value, would be the other way, or 10 times inverse the value, and any combination of that. So we have those. So we've looked at a lot of those different combinations. So one thing that we didn't see quotes for anywhere here was actually swap contracts. And that's because swaps are not actively traded in markets. So the reason they're not traded in markets is because they tend to be customized contracts. And I want to kind of give an explanation about swaps, why we don't see their quotes out there at all, and why if you take any textbook or something, the way they describe swaps in the swap market, it's going to be really sensitive to exactly how old that book was, whether it's from 2015, 2014, 2012, 2010, because the definition of what a swap is, it's changed a lot over the past decade. And a lot of it is due to regulation from the federal government. So swaps are really important in the system, but the regulation has changed a lot, and it's going to change going forward. And some of it doesn't make a whole lot of sense, which is why it's important to understand what's happening with them. So a swap contract, as we mentioned a little bit when we introduced them the other day, so a swap contract, the way it's different from all these other securities we've looked at is it's a derivative, but instead of being based on just one underlying security, it's based on basically a time series of that underlying security. So in some ways it's like a fund, but with a fund, you don't just get one underlying security, you get a whole portfolio of underlying securities, but they're all at the same point in time. So if you buy a stock fund, you get 30 different shares of stock, but you get all of them right now today. With a swap contract, you don't get 30 different shares of stock. But what you would get is the cash flows from a share of stock, from one share of stock, but over some period of time, and you would swap it for another stock. So say you got one stock that pays a 5% dividend, and another stock that pays a 10% dividend, and you want to stay owning the share of stock that you own. Say I own Apple, and you own Netflix. Apple pays whatever, a 2.02% dividend, Netflix pays 0 dividend. And we decide that I don't like my dividend from Apple. I don't really like getting the dividend, maybe because I have to pay taxes on it or something. And you don't like getting no dividends from Netflix because you want the dividends, but you don't want to sell Netflix and I don't want to sell Apple. So we keep owning the same shares of stock, but we swap our dividends. So I give you all my dividends on Apple and you give me nothing because there is no dividend on Netflix. And since I'm giving you a dividend and you're giving me nothing, you probably have to pay me some amount of money now. That would be a swap contract. You pay me, and I give you my dividend, and you give me your dividend, which might be 0. That would be a swap. So it's not just one cash flow we're exchanging. We're exchanging all those dividends over some time period, over, say, the next 5 years, or the next 10 years, or the next 1 year. So we'd exchange that series of cash flows, and that's a swap contract. Now it's kind of complicated, which is why these all had to be basically customized contracts. And after the financial crisis in 2008, there was the Dodd-Frank Financial Reform and Modernization Act, which basically re-regulated a lot of procedures on Wall Street. And one thing it did is it basically said swap contracts need to be standardized and traded on the exchange.